Hey everyone, I have a really interesting fact I want to share with you today. I'm at my self-storage facility right now, and did you know that Extra Space Self-Storage, this is a publicly traded REIT or real estate investment trust. It is the #1 best performing real estate investment trust of the last 10 years. And in fact, when I look at their annual report of Extra Space Self-Storage, their 2019 annual report, they actually surpassed total returns of Apple stock over the last 10 years. So this self-storage industry, it is a really interesting industry. I happen to work in this industry, so I know quite a bit about it. I'm actually just driving around my facility right now in the golf cart. And in fact, today's video is going to be a very deep dive analysis. I spent a lot of time preparing today's video. I have a deep dive analysis for you. And I want to cover 4 publicly traded self-storage REITs. I want to cover Public Storage, Extra Space Self-Storage, CubeSmart, and also National Storage Affiliates. I want to cover all 4 of these REITs because building a self-storage facility like I did is one option, but it is very active. It is a lot of work. It is very active income. But another really awesome option to invest in this industry that has performed so well is through real estate investment trusts or REITs. So I'm going to cover those REITs in the video today. I have a lot of insights to share. Get ready, everyone, for a really exciting video. All right, everyone. So before I get into today's mega analysis, I want to give a little bit of background on the self-storage industry from an investor's standpoint. I'm inside my facility now. You already saw the drive-up units in the intro. What I'm in now are the interior units, and I'm so excited to be here because I could take my jacket off because this is a climate-conditioned floor of the building, and it's nice and warm, even though it's really cold outside. And so self-storage is a highly utilized product here in the United States, and it's starting to become so globally. And in fact, you may not know this, but there are more self-storage facilities in the United States than the McDonald's, Wendy's, and Burger King all combined. And so next time you're driving around town, keep an eye out. You may see self-storage facilities that you never even knew existed. And why is self-storage so popular? Just think of your own situation. We all have so much stuff. And so there are kind of 2 big buckets of people who utilize self-storage. Those who are business owners who need space to store their items on an ongoing basis. Think about general contractors, legal professionals who have a lot of records, people who might have an eBay business and have a bunch of stock. That's kind of the one bucket. There's another bucket of consumers who are going through life events, people who might have a more temporary use, such as, hey, we just got married and we're combining households. Let's put some of our items in storage while we figure it out. Hey, we have a kid on the way, a baby on the way. It's so exciting that we got to get some items out of our house to make room for our growing family. There are those types of customers as well. But it just so happens that many Americans these days utilize self-storage. And so it's a really interesting industry to invest in. And I would say one of the reasons it's so exciting to invest in this industry, either directly or through a real estate investment trust, is because this industry tends to perform very well during all economic cycles. Regardless of whether the economy is good or the economy is bad, there are always customers who are going through life events who need self-storage. Whether the economy is good or the economy is bad, there are always small businesses who are operating their businesses who need the space to store their items. Whether the economy is good or the economy is bad, from a financial standpoint, self-storage is always a better option for most customers than buying a whole new house or putting an addition on an existing home, which could cost a fortune. And whether the economy is good or the economy is bad, typically it is going to be much more affordable for a business customer to rent a self-storage unit or maybe a few units versus renting an entire building for their business. And so from an economic standpoint, it just makes sense. Now, the downside of this industry, or one of the risks of this industry, is it's somewhat of a commodity, if you will. Most customers are out there comparing on price. And so I like to differentiate on quality and on customer service. I like to believe that I offer the best quality, that the customer service is superior. Things like individually alarmed units, things like state-of-the-art digital video surveillance, things like a special elevator with an extended height cab in the elevator, things like climate control, things like music playing throughout the facility just to make it a little bit more pleasant, and of course hiring the best and brightest managers. It's possible to differentiate. But what I'm saying is, no matter how good your brand is, at the end of the day, self-storage is a commodity. And so at a certain point, when you're renting just a 10 by 10, if you will, or 100 square feet, 100 square feet at one place versus another, many consumers are going to try to find the one that has the best price. And so as more and more self-storage facilities get built, that tends to drive the rental rates down. And when the rental rates go down, it makes it more difficult for the operators to earn a profit. And so when one is thinking about investing in this industry, it's important to think about that dynamic. Because certainly there is going to be a point when peak supply is reached, and that when more and more storage facilities get built, it's just too much supply or oversupply, if you will. And so that's something important to keep in mind as a self-storage investor. And it's something to keep in mind, quite frankly, when looking at all the publicly traded REITs. Which of them has the best margins? Which of them is running the leanest operation? Which of them can afford to take on lower rental rates and still do really well? That's one of the metrics I'm actually going to cover in the extensive analysis today. And so with that, I want to get started actually, and I want to jump into that analysis. So in the next segment of today's video, we're going to go through some of these amazing publicly traded REITs in this space. All right, everyone. So let's dig into the numbers right now. Check it out on the screen. And if you want to follow along at home, I have a link in the description below and in the pinned comment below to this very spreadsheet. There's no gateway. It's not hidden anywhere. It is easy for you to download and follow along. And I spent a lot of time preparing this analysis. So if you appreciate that, please give me a thumbs up. It would really mean the world to me. And so what you see on your screen right now is an overview of Extra Space, Public Storage, CubeSmart, and NSA. And so I just start with the first row, which is the price per share, and then I go down to the market capitalization. And so what you can see here is Extra Space self-storage is $14.5 billion by market cap. Public storage is $40 billion by market cap, and then CubeSmart is only $6 billion, and National Storage Affiliates only $2 billion. One of the things that I want to explain right away about the self-storage industry is that the publicly traded REITs, they actually only comprise a small percentage of the industry. A large percentage of the industry are just regional operators who own 1 or 2, maybe 3, 4, 5 facilities, maybe even 20 or 30 facilities, but they're all privately held. And so there's also a lot of what you call in our industry mom and pop operators, which is basically just a family business, if you will. And oftentimes at a self-storage facility, there's even a residence there. And so the mom and pop operators, they often will live at the facility and operate it. And so sometimes you think a big company like Public Storage, they have a corner on the entire self-storage market, but that is not the case. Actually, the publicly traded REITs are a smaller percentage of the overall industry. And so, however, within that smaller percentage of the overall industry, Public Storage, as you can see from the market cap analysis, is by far the largest publicly traded self-storage REIT. So let's keep moving. What you see on the next line is just some distribution information. I call them distributions because these are REITs, real estate investment trusts. And what you see here is that most of these are in this 3% to 4% range. Extra Space is the smallest yield at 3.2%. Public Storage is kind of middle of the range at 3.5%. CubeSmart I highlight, and I highlight basically on this spreadsheet to draw attention to numbers that I found very interesting. So CubeSmart is the highest dividend yield, or distribution yield, if you will. National Storage Affiliates is a close second at 3.9%. And so one of the things I want to explain right away is the dividend yields or distribution yields in this sector right now, they're not very high. You know, I guess they're reasonably high as compared to the overall interest rates. We're at historically low interest rates. But the reason that the distribution yields are not very high here is these stocks have performed very well. The share prices of these REITs over the years have performed very well. I think Extra Space is the prime example as the #1 performing REIT of the last 10 years. And so because the share prices have gone up, the distribution yields, the starting dividend yields, they're not that high. And so what you want to consider there is honestly investing in the self-storage industry right now, whether you're buying a publicly traded REIT or even whether you're trying to go like kind of build a facility or buy a facility. It's all really expensive now. And the reason it's expensive is the market has realized that this is an asset class. This is a segment within commercial real estate. It's just a really good investment. It's a solid investment, a stable investment, as I have already mentioned. And the market over time has taken notice of that. It wasn't always that way. Back in the day, no one really knew what self-storage was. And oftentimes it was kind of an industry that was, I would say, maybe looked down a little bit on. It wasn't quite as cool or as exciting as apartments or shopping centers. But these days, in the world of commercial real estate, it is a very exciting sector, one that ends up oftentimes on the front page of your Wall Street Journal, if you will, or publications like that. It's a hot sector right now. And in fact, there was recently some news even of some prominent investors starting to invest in the industry as well. And so there's a lot of buzz. What that means is the starting dividend yield is not that high. But at the same time, for investors who are looking not necessarily to get a deep discount, but investors who are more conservative, investors who are just looking for something a little bit more stable that performs well in any economy, this is a very interesting sector. Now, given that these are real estate investment trusts, please keep in mind that the distributions are not qualified dividends. Most of the dividend stocks I own, the distributions or the dividends that are paid are considered qualified dividends. So they're taxed right now as long-term capital gains. However, real estate investment trusts, because they avoid the double taxation, there's no taxation paid at the corporate level or the entity level. The taxation is different at the investor level. And that taxation is usually treated as kind of threefold. There's the ordinary income component of it, which typically is the lion's share. That's treated as your ordinary income tax rate. There's a capital gains component of it sometimes, and then there's a return of capital component of it as well. And so with a real estate investment trust, I would say one of the benefits of it is it gives any investor instant exposure to real estate. And it gives any investor passive exposure to real estate because building or buying a self-storage facility or an apartment building, it is a lot of work. It's very active to manage one of these businesses. But buying a REIT, it's totally passive. Now, the downside of this is a real estate investment trust will add a little bit more complexity to the tax situation for dividend investors, as long as it's in a ordinary kind of taxable account. In a retirement account, it's a lot easier, obviously, but in a taxable account, someone who wants to use the cash flow before they're at a traditional retirement age, the tax situation is a little bit more tricky than a standard dividend stock that pays qualified dividends. So moving on, check it out on the screen. What I want to talk about next is the growth rate on these dividends. So whereas the starting dividend yield or distribution yield on these stocks is not that exciting other than CubeSmart at 4%, one of the things that is really exciting is the 5-year compound annual growth rate. These real estate investment trusts in the self-storage sector have been increasing the dividend pretty quickly. Extra Space for the last 5 years has been 8.8% per year. CubeSmart, 15.6%. National Storage Affiliates at 12.3%. Now, obviously, I don't think the growth rate at CubeSmart or National Storage Affiliates will last forever. The reason it's growing so quickly is these are smaller entities. But once they reach a certain size, obviously, they may not grow as quickly. And you're seeing that with Public Storage with the slowest growing dividend. And that being said, Extra Space is a somewhat mature company with a larger market cap. And so it's really nice to see their solid dividend distribution growth rate. And as I've mentioned in some of my videos over the years, as a dividend investor, I personally target a dividend growth rate in kind of that 7 to 8% range on average per year. That's my sweet spot. And if a company can sustain that over the long run, man, that offers a phenomenal opportunity for a huge yield on cost, which basically allows an investor to live off of dividends. And so it's nice to see in this sector that I know so well that the dividends are growing so quickly. So let's move along, check it out. What I want to do next is just talk about the assets and liabilities, the balance sheets of these companies. And so it's really interesting. The outlier here, I would say, is Public Storage. So whereas Public Storage, I would say, wins on market cap, it's the biggest. I like biggest because we're in a winner-takes-all economy, in my opinion, especially at the pandemic. It's totally a winner-takes-all economy. Unfortunately, smaller enterprise has it a little bit more difficult. Whereas Public Storage kind of loses, I would say, on the dividend growth rate. Where they really shine is the balance sheet. And so one of my personal biggest takeaways out of this entire analysis is what you're going to see right now with the balance sheet. And so just check it out. At a glance, the assets are actually surprisingly low at Public Storage, as you would think based on the market cap. So Extra Space, $8 billion, $8.5 billion in assets. Public Storage, 11.3, CubeSmart, 4, National Storage Affiliates, 3. But before I move on, one of the things I want to point out at Public Storage is they've been around a really, really long time. And on their balance sheet, on the assets column, or the assets part of the balance sheet, they have something called accumulated depreciation on the balance sheet. And it shows that they have $6.6 billion negative of accumulated depreciation. And I actually did not see such accumulated depreciation on Extra Space, CubeSmart, nor National Storage Affiliates. And so the way I look at it, the way that Public Storage is keeping their books, it may understate the assets, the real value of the assets, because in real estate, there's this concept of depreciation. There's this concept of phantom income, if you will. And one of the reasons, quite frankly, you'll see in a minute, in real estate, with real estate investment trusts, it's important to look at this metric called funds from operations, or FFO. It's more important to look at that than earnings per share, or earnings, because earnings are post-depreciation. GAAP earnings, generally accepted accounting principles, it is post-depreciation. But basically in real estate, what happens is you can depreciate these buildings on a certain schedule that is allowable by tax code. And that depreciation is really helpful because when it comes time to pay taxes, it's almost a tax advantage, if you will, to the real estate investor. But it's not that the building is really losing that much value over time. Surely you have to invest capital improvements into the buildings, but the depreciation schedules, typically they kind of overstate, if you will, the CapEx that's going to be required to maintain and improve the building. And so the way I look at it, over the years, Public Storage has basically enjoyed a lot of depreciation. And I was reading up on this. They're carrying it on the balance sheet on the assets part as a negative. And that's based on the general accepted accounting principles. It seems like that's what you're supposed to do. And so it looks like what Public Storage is doing makes sense. But what I'm saying is one of the reasons I think their assets look so low is they've been around for a long time. They're really the leader in this industry, the first mover, if you will, in the industry. And so I think they just have so much accumulated depreciation that it's making their assets look lower than it really is in real life, the real value of these buildings, if you will. And so that was a huge takeaway for me. Now, check it out on the screen. Moving on, one of the things that I thought was awesome, again, with Public Storage is the liabilities. these guys, Extra Space has $5.6 billion in debt, I shouldn't say just debt, but in liabilities. Public Storage only has $2.2 billion, same as CubeSmart, 2.2, and then NSA 1.6. The shareholders' equity, or book value, if you will, for Public Storage is a staggering $9 billion. And that's a $9 billion on an asset base that I think, quite frankly, is understated. And it's certainly understated at least by this accumulated depreciation, but I think it's even more understated than that. I think it's the value of the property is potentially even more than is being captured there on the balance sheet, even taking that accumulated depreciation out of the picture. And so one of the huge takeaways I took from all of this is, man, I love it. Going into this weird world we live in right now, going into a new year, we don't know what the economy holds. We don't know what the pandemic holds. I do know that self-storage is an industry that people need, but I like it. If I were to pick one of these stocks, I will tell you that the one that is at the top of the pack for me right now, being a more defensive investor, is Public Storage. Because quite frankly, why would someone invest in this sector? Well, I think total returns is one reason, but another reason is defensive. If you're a defensive investor, if you're someone that wants a stock that is predictable, that's going to be around, that's going to thrive in any kind of economy, that's the reason to invest in this sector, one of them at least. And within the companies in this sector, man, I'm impressed with Public Storage, how defensive their balance sheet is. It's just phenomenal. So let's keep going, check it out. And so next, what I want to do is I want to get into some revenue analysis. And so I just wanted to understand how quickly are these companies growing. And so I looked at their revenue over the last 4 years, and I looked at a compound annual growth rate. And again, I highlight what stands out. And obviously, Public Storage is the loser. Being a bigger company, it's harder for them to grow. And some of their smaller peers are growing quicker. NSA is growing the quickest at 30% compound annual growth rate on revenue. And Extra Space is at 14%. I would say Extra Space, honestly, being a company that's already a little bit bigger at a market capitalization of $14 billion, being a lot bigger than NSA and CubeSmart, I thought it was interesting to see that their compound annual growth rate on the revenue was so high. That impressed me about Extra Space. And speaking about Extra Space, one thing I would just say that is not captured in the numbers here that you're seeing is I have a marketing background. I've spent my entire career in marketing with a focus on digital marketing. I'm a real estate developer as well, but my specialty lies in marketing. That's kind of the base that I've built my career off. And one thing I will say is consistently in the industry of self-storage, Extra Space, in my opinion, and this is more subjective, but I believe that they have the best brand and they have the best marketing and the best digital marketing by far. And I've seen members of their digital marketing team present at conferences. I have tracked them over the course of my career. Even before I worked in the self-storage industry, I knew of Extra Space's competencies in digital marketing because they were always at the conferences. And I would just say, it doesn't surprise me that their revenue is growing so quickly despite them being already at a bigger base, because they are so strong at sales and marketing. And so I really like that about Extra Space. And so let's keep moving. Check it out. The next thing that I wanted to go through, and this is, I think, what we probably what you have all been waiting for, is funds from operations. And so funds from operations is basically the earnings of a real estate investment trust. It's basically what it takes is it takes the earnings, but then what it does is it adds back depreciation and amortization, and it also subtracts out sales. And so gains from sales of I'm sorry, not all sales, but gains from sales of assets. And so basically, funds from operations, earnings plus depreciation and amortization minus any gains from sales of property, I believe is a very truthful way to look at the earnings, if you will, of these companies, and of not only self-storage companies, but any real estate investment trust. And one of the things, honestly, I hope you take away from this video is I get a lot of questions about REITs. A lot of people want exposure to real estate. A lot of people realize that there's been huge wealth generation through real estate, and it will probably continue. And so they're wondering, Ian, how do you analyze REITs? How do you look at it? It's a little bit different than a common stock of McDonald's, for example. And so the way I look at REITs is this. I look at funds from operations. And so anyways, check it out on the screen. What you see is that Extra Space drove $667 million FFO. This is all 2019 data. I pulled this data from their annual report. Public storage, 1.8 billion funds from operations. Cube, 326 million. NSA, 140 million. And so you get a sense of just magnitude there. Obviously, it makes sense, the market caps, because they're driven by earnings, and the earnings from public storage are by far the largest. Now, here's where it gets really, really interesting. And so a lot of people with just normal stocks like McDonald's, they look at net margins. I love looking at net margins. Net margins are basically earnings divided by revenue, and you get a sense of how profitable a business is. You get a sense of, hey, for every dollar of sales that are made, how much of that dollar do they get to keep? Do they get to keep 10% of it, 20% of it, 30% of it? How does that work out? And so what I'm doing here is I'm doing a net margin, if you will, but it's an FFO margin. I'm taking FFO and I'm dividing it by revenue. And so what you see on the screen is an FFO margin, and it quickly stands out that public storage has the best margins. CubeSmart second best, third best Extra, and then NSA at only 36 actually is a little bit alarming to me. I would say for myself personally, I would not invest in national storage affiliates. I wish them all the best, but I feel that this kind of FFO margin, that's not good enough for me. Now, I'll give you some context. The reason that public storage has the best FFO margin, they are known in our industry for being more lean. They are known in our industry for being more scrappy. They are known in our industry for, hey, if there's something, we need to repaint the facility, let's just wait one more year. Don't do it this year. Let's just wait a little longer. They're known in the industry, hey, this needs to be fixed. You have option A that costs this much, or option B that costs this much, but option B is like way better. We'll go with option A. And so they are known for that. And so it's so interesting to see in the numbers, man, what a brilliant FFO margin. And they work hard for that. They're scrappy for that. They're lean for that. Is that the best strategy over the long term? Time will tell. But in the short run, it really boosts their margins. Now, I'll contrast that with Extra Space. Extra Space is known in the industry for putting a little bit more into the properties, having a little bit more of a premium property, spending a little more on customer experience. And so, yeah, it's at the expense of the margin, the FFO margin, but in the long run, is that going to help them scale the business more? Because maybe they run the business at a lower margin, if you will, but the revenue grows quicker, and we're seeing quicker revenue growth at Extra Space than PSA. And so there's pros and cons here, but on a strict FFO margin, I have to say that public storage is the winner here. But again, I understand why Extra Space is lower. It's intentional. And CubeSmart, it actually surprised me. I didn't realize their margins were that high. And so it seems like CubeSmart is taking maybe an approach, it's kind of between public storage and Extra, kind of in the middle. Now, to be fair to public storage, one of the reasons that their FFO margins are strong as well is being the largest company, there's economies of scale. And so something else worth noting with them is they're adapting technologies. And so maybe they are relying on automation a little bit, or artificial intelligence, kiosks, that kind of thing. And again, I have mixed opinions on that. There are certain self-storage operators that believe automation is the way to go, and it increases margins. There's other self-storage operators that believe, hey, don't automate, have a person-to-person experience, and that costs a lot more, but in the long run your margins are lower, but you have less churn at your facility. People stay at the facility longer, and so there's kind of that side of things as well. Is one better than the other? It's hard to say. Let's keep going. And so what you see on the screen next, I do actually a FFO per share. So I just take shares outstanding and I extrapolate what the FFO per share is. And I wanted to understand as best as I could, what is a real estate investment trust comparable to a PE ratio? Because I talk on my channel so much about PE ratio, or price earnings ratio, which is the price of a stock divided by the earnings per share. And typically with a dividend stock, different industries have different PE ranges, but like a PE at like a 10, for example, is usually kind of a bargain. A PE at 15 is kind of still okay, worth buying, but kind of 15 to 17, like normal value. You start getting PE of 20 or 25, more expensive, kind of pricey. 25 to 30, pricey. I'm just speaking in general here. And so I just want to understand what kind of PE do these companies have, these real estate investment trusts. And so what I did is, once I knew what the FFO per share is, and they don't report this on the annual report, I have to calculate these numbers myself, but I take the price per share and I divide by the FFO per share, I get what you see on the screen right now. And what you see is that basically all of these are kind of in this 20 range, 21.94 for EXR, PSA 21.98, Cube I highlight at 19.33, it's the cheapest, NSA most expensive at 22.47. Biggest takeaway from this line is that all of these are fairly priced, if not kind of premium priced a little bit. None of them are cheap now. Why are none of them cheap? Like I said, it's kind of a darling industry, if you will, right now. It's an industry that defensive investors like. And quite frankly, with all the unknowns going on in our world right now, this is a reasonably desirable industry to invest in. And so, again, I don't see a bargain basement stock pick here. I don't see something, wow, go out and buy it because it's on sale. But what I see is 4 solid companies. All of them have their own pros and cons. PSA is probably my favorite. Extra Space, close number 2. Cube is 3, and then NSA is 4. But they're all priced pretty fairly. There's no discount. So let's keep going. What you see next is I just have same-store occupancy. I highlight Extra Space here. It has the best occupancy. And this kind of goes back to what I was just saying. Extra Space, look, their FFO margin's a little bit lower than PSA, 51% instead of 64%. But, hey, they're spending more money. They're taking less margin. But what does that mean? They have more occupancy. They have a higher occupancy. So out of every 100 self-storage units, 92 of them are full. 8 of them are vacant. You have a little bit of a lower occupancy at Public Storage, and it goes lower at Cube and NSA. And so I would just say at Extra Space, they've done a great job on their branding, a great job on their marketing, their in-store experience, and I think it's led to a strong same-store property occupancy. What you see next is just the number of stores. All of these companies have a lot of stores. Public Storage has 2,800. 1,100 at PSA or at EXR, and then the 500s at NSA and Cube. And also, these some of these companies do some third-party management. In fact, CubeSmart does third-party management, I believe, too, but I didn't really capture it here. But I broke out what I could from the annual report, so it was easy to find. And what third-party management means is, hey, if you're a real estate developer, or I am, I can go out and build a self-storage facility, but then I can say, hey, Extra Space, I'm going to hire you to manage my facility, and you're going to put your name on it, you're going to do your thing, you're going to run it for me, and for that, I'm going to cut you a check, I'm going to pay you a fee every month. And similar to the hotel industry, quite frankly. In hotels, for example, real estate developer acquires land, builds a hotel, and then they go out and they hire Marriott. And they're like, hey, Marriott, I want to brand this as a Marriott hotel. You're going to manage it for me. So it's the same kind of thing. So that's what you're seeing there in the third-party management. And again, this is not completely accurate because I break it out where I can. But for Cube, I know they do it. I don't break it out here just because I couldn't find it easily in their annual report. Let's keep going. So what you see next is just the average rent per square foot. A lot of this is market driven. More urban areas have higher rents. More suburban areas have lower rents. you see that Extra and Public Storage are in the same range at $1.37 per square foot per month. Cube has really got a strong $1.48 per square foot per month, and that really speaks to the fact that CubeSmart is in more urban areas. And I know they just bought a large $500 million portfolio in the New York area, New York City. And so those are very expensive rents on a per square foot per month basis. And so that's why Cube has the strongest rental rates on a per square foot basis, but it's largely driven by geography. So let's keep moving. At the bottom of this spreadsheet, actually, you don't even see this on the screen, but I just have a few notes. I would say the notes that I'm reading, it basically says that Extra has the best 10-year total return of any REIT. It says that PSA has some international exposure. And so, in fact, I want to get into that next. This is going to be a longer video today, everyone. I hope you're enjoying it. And I hope it gives a wealth of information, not only about this self-storage industry, but also just about REITs in general, because I get a lot of questions on REITs. So give me a thumbs up if you like the video today. Please do. I put a lot of work into this. Thumbs up means a lot to me. What I want to do next is show you a screenshot. Check it out. What you're going to see on your screen right now is some information from Public Storage on their stores. And one of the things I want to point out for Public Storage, actually, is they acquired a company called SureGuard. Shout out if you remember SureGuard. They were an independent company a while ago, and then they got acquired by Public Storage. But SureGuard had operations both in the United States and also internationally. And you can see here, one of the things I like about Public Storage is they not only have all of these properties in the United States, but they also have business parks in the United States, but also they have SureGuard, and SureGuard offers a self-storage experience internationally, and I really value that about Public Storage. Out of all these companies, it's really the only one that I would say has a strong presence internationally. And being an investor who believes in international investing, being part of a community here on PPCE, and that I really celebrate the fact that we have members of this community from all over the world. I really like that about Public Storage. I think that's pretty cool. And so that was something I wanted to show you. I would say next, I'm just jumping around here, but what I want to show you next is, check it out on the screen. I'm going to show you a few statistics from Extra Space self-storage. And so what you see here on Extra Space is just selected data from the last 3 years. But what I want to show you again is FFO versus net income. And so if you look at the revenue, 1.3 billion for 2019, you see kind of operating expenses, G&A expenses. There's your depreciation and amortization. You have interest expense too. Interest expense is a big expense for this company because of the amount of debt that they have. Most real estate companies, quite frankly, debt is a big deal. And so you kind of back in here at the bottom to net income. But what you see here under other data, it shows FFO. Basically, the difference between net income and FFO is it wipes out the depreciation and amortization. And again, the depreciation and amortization, it's not a real expenses, if you will. It's a tax write-off. It's phantom income, if you will. It's a tax advantage. And so FFO is a better measure, if you will, of the real cash flow, of what's really coming through, the real earnings. And so I just wanted to show this screenshot really quickly to give an overview of that again, because I think it's a really important concept to understand with REITs. And so moving on, check it out on the screen right now. I did my introduction earlier today when I was at the self-storage facility, but off memory, I couldn't remember everything. And so I want to just close out the video today with a little bit more information on the industry for those who are interested in learning more about the industry. So in front of you right now, I'm just going to go over the bullet points that I did not speak to earlier in the introduction today. One thing I would say again is the industry is very fragmented. A lot of people think that the publicly traded REITs capture the whole industry, but they don't. It's actually a small percentage of the industry. Most of the industry is privately held and regional operators, mom and pop. I talked about the fact that it's a commodity, so I'm not going to go into that more. I talked about the fact that life events drive sales, drive rentals for self-storage, so I don't want to talk about that again. So one of the other things I wanted to mention is it's exceptionally expensive to build or to buy a self-storage facility these days. And so facilities are trading at cap rates maybe in the 4s, 5s, and 6s. Historically, they've traded at a 7 or 8 cap. Give me a thumbs up or a comment below if you want me to do more real estate videos here on PPC and would like to learn more about these types of concepts like cap rates. But basically what cap rate is it's a metric that shows as a percentage of net operating income, what is the facility selling for. It's basically net operating income divided by the value, if you will, of the self-storage facility, the current market value. And facilities in the olden days would trade maybe at a 7 or 8 cap, and you could kind of build to a 7 or 8 cap, maybe even higher. But these days, facilities are trading at lower caps, like 4 caps in really urban environments that are really desirable, 5 or 6 caps for a nicer facility and maybe a more suburban or tertiary market. It's expensive. And so what I'm trying to say is these days, real estate investment trusts, even though they're a little bit priced kind of fairly at these PEs, if you will, or FFO-based PEs in the low 20s, it's not necessarily a bad trade-off versus actually building one of these things, at least in this market, because it's so expensive to build or to buy a standalone facility. So that's one insight I wanted to share. I want to keep going. I have some more insights. I would say there's some barriers to entry. It's really hard these days to find land, especially infill locations, for example, in markets that are a little bit more urban or more populated. There's only so much land available, and land has to be basically zoned for storage. And oftentimes, even if it's already zoned for storage, you have to get a conditional use permit to get your facility approved. And a lot of communities have put a moratorium on more self-storage or sometimes feel like they might have enough self-storage, so it's very difficult to build one. And so, again, a case, for example, to invest in these types of real estate investment trusts is that, look, what they own is of value. And yes, it is a commodity, and if too many get built, it drives prices down. But on the flip side, I'm not so sure there will be a problem of getting overbuilt, at least in the kind of tier 1 markets, because there's no more land available, and the land that is available, the cities typically want something else built there. And quite frankly, most of what's available, it's not zoned industrial, it's not zoned for the self-storage. And so again, that's a flip side, kind of a counterpoint to what I was saying at the beginning of the video, that what public storage has, what Extra Space has, it is valuable because there's not going to be too many more of them potentially, at least in tier 1 markets. So moving on, this is an asset-heavy business. Obviously, these assets are worth a lot of money. It oftentimes takes a lot of debt to finance them. The low interest rates are a huge plus, and if you believe interest rates are going to stay low, that's generally a good thing for real estate investment trusts, not just storage, but any real estate investment trust. If you believe interest rates are going up, that's probably a bad thing for real estate investment trusts, and so something to keep in mind. Storages, they do have a really reasonably strong margin business. One thing I would say, though, and a lot of people I think get wrong about storages, and I see this sometimes with people who are newer to the business, it is very, very operationally intense to manage one of these things. At any given facility, you might have 1,000 units. That's 1,000 different customers to deal with. And look, maybe you're 90% full. That's 900 different customers to deal with. Things get beat up, trucks back into buildings, stuff breaks. It is operationally intense. You have employees, you have to deal with paperwork, you have to deal with all kinds of stuff, rental agreements, you have to coordinate moving trucks, and you have to have security systems. It is operationally intense. And so sometimes think, oh, you're just renting a space to someone. No, there's a lot that goes into operations, and so it's really active. And so sometimes investing in something like that through a REIT, it's really desirable because it's passive versus taking a hands-on approach to becoming your own mom and pop, if you will. And so that was something else I wanted to share. Now I'm moving in now to the end of the video today. Check it out on the screen. I just want to share some conclusions really quickly. My best overall winner is public storage. Best FFO margins is public storage, with NSA being a big loser here. Best balance sheet is public storage. but it is also indicative of just first mover advantage and older business. Best same-store occupancy, Extra Space. Best rental rates, CubeSmart. Fastest revenue growth, NSA, followed by EXR. Best dividend distribution growth is Cube, followed by EXR and NSA, both being respectable. PSA is a big loser on this metric, not growing very quickly. Best brand, Extra Space. Best by market cap, Public Storage and Extra Space. Best international exposure, Public Storage. Best value on a price per FFO is Cube. Overall, those are my conclusions. What I would say is you've got 4 great REITs, and if I were to invest in one of these REITs right now, I would personally go with Public Storage based on my analysis here, but my close runner-up would be Extra Space. I think that they could have metrics more like Public Storage if they wanted to run a little bit leaner. But then again, I don't think they can change their balance sheet overnight, and Public Storage will always have the superior balance sheet. So I really like that about Public Storage. I would also like to point out here, before I conclude the video today, there are other players in this industry, 2 in particular. There's one called Life Storage. That company is not a REIT. It's actually a corporation. So I didn't include it here because it's a different way of looking at things. It's not a real estate investment trust. Maybe I'll look at that one in a future video. And there's another one called U-Haul Group. And U-Haul, they're known for renting out those trucks and trailers, but they also operate self-storage facilities as well. And so they're in the moving and self-storage industry as well. Again, I could look at them in a future video, but it's not as apples to apples. They have a little bit of a different business. And U-Haul, again, is a corporation, and so it's not a real estate investment trust. I really wanted to take the opportunity today to go through the basics, my analysis of the self-storage industry through the real estate investment trust lens, because I know a lot of you out there are looking to improve your skills and learn your skills on analyzing real estate investment trusts. Everyone, I really hope you enjoyed the video today. Please give me a thumbs up if you enjoyed the video. If you want to support my efforts here, you can buy me a coffee. I'll include a link in the pinned comment below. Also, I'm on Patreon. I'm doing new videos on Patreon every week for my patrons. They're more impromptu videos. I usually try to do it 2 a week or 1 a week. And most recently I've been doing them kind of on Sunday, Monday, because I like to do something a little bit motivational for the week ahead for the patrons. A big shout out and thank you to all the patrons there, because the support on Patreon helps fuel what I'm doing here on YouTube. I put a lot of time and effort into the video today. So again, thumbs up, thumbs up, thumbs up. Please hit the like button all you can. Put in the comments below what you think about the video today, what you think about the self-storage industry, what you think about real estate investment trusts, what your strategy is. As always, let's share with each other in this community. Before I leave today, in terms of full disclosure, I am long McDonald's, ticker symbol MCD. Also, before I leave today, in terms of a disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. Investing in the stock market, in real estate investment trusts, and real estate, all of it contains an extraordinary amount of risk. I am tired, everyone. I love you all. Like button, please. I love you all. I'll see you in the next video.